Navigating the tides. The impact of economic downturns on various asset classes. Introduction. The undulating nature of economic cycles, marked by periods of expansion and contraction, has profound implications for investors navigating the complex terrain of financial markets. Economic downturns, epitomized by recessions, cast a shadow over the investment landscape, triggering a cascade of effects on different asset classes. Understanding how various investments respond to the ebb and flow of economic tides is essential for crafting resilient portfolios capable of weathering the storms of financial uncertainty. Equities. The roller coaster ride. Equities, or stocks, are often viewed as the bellwether of market sentiment. During economic downturns, stock prices typically experience heightened volatility as investors grapple with uncertainty about corporate earnings and economic prospects. Companies across industries may face challenges, leading to lower profits and, consequently, diminished stock values. However, the impact on equities is not uniform. Defensive sectors such as healthcare and utilities, which provide essential services regardless of economic conditions, may exhibit more resilience. Conversely, cyclical sectors like manufacturing and technology tend to be more sensitive to economic fluctuations, experiencing sharper declines during recessions. Astute investors leverage this divergence to strategically position their portfolios, balancing exposure to defensive and cyclical stocks based on their risk tolerance and market outlook. Fixed income securities. The safe harbor. In contrast to the tumultuous nature of equities, fixed income securities, including government bonds and corporate bonds, often emerge as a safe harbor during economic downturns. As investors seek refuge from market volatility, the demand for bonds rises, leading to higher bond prices and lower yields. Central banks may respond to economic challenges by lowering interest rates, further supporting the bond market. Government bonds, considered low-risk assets, become particularly attractive in times of uncertainty, leading to a flight to quality. Corporate bonds, however, face increased credit risk as companies grapple with financial stress. Investors must carefully assess the creditworthiness of corporate issuers, recognizing that economic downturns can amplify default risks within the fixed income space. Real estate. Navigating the property landscape. Real estate, a tangible asset class, exhibits a nuanced response to economic downturns. Residential real estate, often considered a defensive investment, may experience more stability as people prioritize housing needs regardless of economic conditions. However, the commercial real estate sector, including office buildings, retail spaces, and hospitality properties, can face headwinds during recessions. The demand for office space may wane as companies adopt remote work arrangements, retail spaces may grapple with reduced consumer spending. And the hospitality sector may experience a decline in tourism and business travel. Savvy real estate investors carefully assess the dynamics of individual markets and property types, recognizing that economic downturns can create both challenges and opportunities within the real estate landscape. Commodities. Riding the waves of supply and demand. Commodities, spanning a broad spectrum from precious metals to agricultural products, respond to economic downturns based on supply and demand dynamics. During recessions, reduced industrial activity can lead to a decline in demand for commodities such as oil and metals. Conversely, certain commodities may exhibit resilience due to their role as safe haven assets. Gold, for example, is often perceived as a store of value during economic uncertainty, attracting investors seeking a hedge against inflation and currency depreciation. Agricultural commodities, driven by global food demand, may display relative stability as essential goods. Investors in commodities must navigate the intricate balance between global economic forces and the unique supply and demand dynamics of each commodity. Currencies. The Forex chessboard. Currencies, subject to the ebbs and flows of global economic forces, undergo significant shifts during economic downturns. The value of a currency can be influenced by central bank policies, trade balances, and investor sentiment. In times of economic uncertainty, investors may flock to currencies perceived as safe havens, such as the US dollar, Swiss franc, or Japanese yen. Conversely, currencies tied to economies heavily reliant on exports may face depreciation pressure as global demand contracts. Currency traders adeptly navigate the Forex chessboard, capitalizing on shifts in interest rates, geopolitical events, and economic indicators to anticipate currency movements during economic downturns. Alternative investments. Exploring uncharted waters. The landscape of alternative investments, encompassing hedge funds, private equity, and venture capital, showcases a diverse array of responses to economic downturns. Hedge funds, employing diverse strategies, may aim to generate returns irrespective of market direction, making them attractive during periods of heightened volatility. Private equity and venture capital, while exposed to the economic climate, may identify unique investment opportunities amid distressed markets. The illiquid nature of these investments demands a long-term perspective, as economic recoveries can unlock substantial value in private markets. Conclusion. As economic downturns cast their shadows across global markets, the response of different asset classes becomes a pivotal consideration for investors. Equities, fixed income securities, real estate, commodities, currencies, and alternative investments each navigate the turbulent waters of economic uncertainty in their own distinct ways. A nuanced understanding of the dynamics at play empowers investors to strategically allocate their portfolios, balancing risk and reward. To weather the storms and emerge resilient in the face of economic challenges. In the ever-evolving landscape of finance, adaptability and informed decision-making become the compass guiding investors through the intricate interplay of economic cycles and diverse asset classes.